When the housing market overheats, authorities often regulate bank loans. The emergence of lightly regulated online intermediaries, however, can make it harder to curb speculation. In a paper with Fabio Braggion and Haikun, we studied the Chinese housing market, which has been growing very rapidly in recent years, buoyed in part by rampant speculation. This is a big headache for the country's financial authorities, who would like to prevent a sudden bust, which might lead to mass insolvency. In 2013, the Chinese government tightened the limits on the amounts that home buyers could borrow from banks in several locations where the market was overheating. Banks in those areas could lend no more than 60% of the property's worth for the purchase of a second home. This loan-to-value cap implies a 40% down payment, which makes a home purchase much more expensive. This is precisely the point of the cap, which aims to reduce the bank's exposure and to curb speculation. However, individuals may try to elude the cap and make up for the shortfall via lightly regulated online intermediaries, the so-called marketplace credit platforms. These online intermediaries usually function as micro-lenders to small businesses and are not meant to be in competition with traditional banks, which is why until recently they were not subject to the same scrutiny by the regulator. We find that there was a 31% increase in marketplace loans where the cap was introduced relative to other regions. This is consistent with the view that some of those loans were used to bypass the loan-to-value cap. In addition, among loans to homeowners who are the focus of the cap, late payments increased by 1.6 percentage points and defaults by 2.4 percentage points compared to areas without the cap. What conclusions can we draw then? Banks have indeed reduced their exposure, but the housing market has not cooled down by as much as the authorities were hoping. Moreover, a sizable volume of credit has moved from the official banking sector to opaque and poorly regulated operators. Therefore, regulation with a narrow target on the traditional banking sector can be eluded, and that suggests that a market crash is perhaps no less likely despite these measures.